KING-KAMBUF, 100 proof, giving you nothing but the truth. So, I'm about to start this new chapters. It looks like we're gonna have a minimum 20 of them. I don't know how we're gonna parse this up, but we'll see. This is a lot of words and a lot of information, and this is how I'm gonna conquer this, you see. And maybe, just maybe, it'll help you conquer it too. This is just some instructions, some inspiration to the nation. Good for review, good to let it sink in, attach it to song, so it has a hitchman. Let's go. Here we go. Property and Casualty Insurance License Exam Unit 1. Introduction to Insurance. Introduction. We say natural disasters like tornadoes, hurricanes, wildfires, and winter storms cause billions of dollars in losses each year for individuals and businesses alike. Homes and commercials, buildings are ruined, lives are disrupted, and everything comes to a standstill. Without insurance protection, recovery from these financial losses will be nearly impossible. When you enter the insurance industry, regardless of your role, you will need to know how many things include the purpose of each policy, the claim settlement processes, and languages of insurance, which includes important terms, definitions, and concepts. In understanding, insurance is like putting the puzzle together, pieces like pieces. Unit 1, introductions to know the terms and insurance concepts, the border of the puzzle, the definitions to represent the framework, and the remaining units are highly tested on the state exams. Important words and context are bolded in text, and glossaries are located in the back of this book to assist you with learning the processes. Throughout the course, you will study pieces of insurance puzzles, and they will be built a solid foundation of passing an insurance license exam. When you begin studying, you might struggle with the content and the language, but like a puzzle, contemplating all units will form an entire picture. Learning objects. After successfully completing this lesson, you will be able to define insurance, identify the 2 types of risk, identify the 3 types of hazards like this, identify examples of peril, identify the 5 ways of managing risk, describe the 2 parties involved in an insurance contract and their responsibilities, explain the law of large numbers, adverse selection and reinsurance, identify the 6 elements of insurance risk, identify the 8 types of insurers, compare private versus government insurers, compare domestic, foreign, and alien insurers, identify authorized, admit versus unauthorized, non-admitted insurers, explain surplus lines insurers, explain financial ratings and insurers of insurers, identify the 4 agencies, systems of insurance markets and distributions, identify the direct response systems of insurance markets and distributions, define the law of agency, define the terms, agencies, and principles, identify the 3 types of producers, authority, and identify the producers, fiduciaries, responsibility to applicants and insured. 1.3 Definitions. An insurance policy is a legal contract, so the terminology can be confusing. This unit will address common insurance terms and provide realistic examples to help you understand The definition, risk, and possibilities that a loss will occur when a person purchases insurance. The risks he might face, including storm damages, fire, theft, a car accident. These risks are transferred from the insurer to the insurer. Insurance is a contract to transfer the risk, the financial loss, from an individual or a business to an insurance company. Insurance is designed to cover only loss that involves risk. For example, every time you get in your car to drive to work in the morning, you are taking risks that you always have a chance of getting into a car accident may happen, and you will suffer the unexpected loss. It's possible for the individual to plan for this type of loss. Unexpected events like this are reasons to risk are transferred to insurance company. Insurance transfers and risk from personal or business and insurers. These are two types of risk. Speculative and pure. Speculative risk has a possibility of loss and also the possibility of a gain. Gambling and investing are examples of speculative investments. Risk: you could win money and you could lose money. Insurance companies would not insure you to go to Las Vegas to gamble in case you lose money. Pure risk involved the possibility of experiencing a loss, not a gain. The chance of being in a car accident is pure risk. Pure risk can be covered by insurance like this. Risk: speculative, pure risk, uncertain, probability of loss. Types of risk: speculative risk, chance of loss or gain, not insurable. Pure risk, chance of loss only. Insurance companies will insure. The potential for accidents and other losses is called exposure. Insurance companies can underwrite departments to evaluate the risk and the rate of insurance exposures. This is how insurance companies determine premium rates and decide whether or not they will offer insurance. The more drivers, the more exposure. She has 2 accidents and other potential problems. The example: a person who drives his car to and from sales calls all day will have higher exposure to risk than someone who works remote and makes sale calls over the phone. The higher the exposure to risk, the higher the premium. At least how they sell this. Exposure risks for which the insurance companies will be liable for this. This causes a loss and called a peril. Insurance policies will cover various perils. For example, if the house burns down, the peril cause of loss. This fires, electronics in the home are destroyed because of lightning. This causes a loss. Peril is lightning. If the driver drove his car through a hailstorm and the car got body damage, the peril is hail. The peril is simply the cause of the loss. We see peril, the cause of the loss. The house burns down. Peril is the fire. A loss is defined as one unintended, unforeseen damage to property, to injury, or the amount. There are 2 types of loss. Direct loss is physical loss to property with no intervening cause. Example of direct loss includes lightning striking a house, an automobile hitting a tree. Indirect loss is a consequential loss as the result from the direct loss. Example: indirect loss including loss of rental income due to a house fire, which causes a loss of profit for the landlord. The indirect loss is always consequential of the direct loss. Direct versus indirect loss. Direct physical loss. Indirect consequential. A physical loss, a hazard, is anything that increases the chance that a loss will occur. When you think of the term hazard, just think of something that becomes more dangerous and will make a more loss more likely to happen. You can think of a hazard in the same way as a person parents his child. When the parent says to their child, "Get down before you get hurt," she is cautioning the child to avoid harm. In general, there is a higher chance of getting hurt, causing a harm, if the person is doing something that he, she, or should not do. Hazards can be caused and lost by the making of a loss by making it more likely. There is three types of hazards: physical, moral, and morale. This is name implies hazard of loss and physical identifiable factors that increase the chance of loss. If the tires of the car are slick with the little and no tread possible, the car accident increases. A dead tree in the yard increases possibilities of the trees falling on the house. Consider this: have ever visited a restaurant where the cleaning staff recently mopped the floor? You usually see a bright yellow sign alerting guests to the wet floor. The wet floor is a physical hazard, for someone is more likely to slip and fall. Moral hazard arise with the individual's characteristics. Loss may more likely occur to the individuals who lack morals. As a result, the individuals are hazardous to the insurance companies. Dishonesty is a moral hazard because it may increase the chance that the individual lies on the insurance application or face a loss. Morale hazardous are states of minds and fines and careless attitudes in common usage. A moral hazard is unconscious change in a person's actions or behaviors. An example of moral hazards is an insured careless leaving the door and windows unlocked when not at home, alone or not, or the insurance leaving a car running and unlocked while running into the store for a quick item. Hazards. Hazards increase the chance of a loss. Physical hazards. The hazard can be seen. Moral hazards. Dishonesty. Morale hazards. Carelessness. Methods of handling risk. An individual for a business has exposure to many risks. This can result in significant losses. Building a home can burn cars to get accidents. Employees can get hurt on the job and people can die unexpectedly. There are numbers of ways that these risks can be managed. It is easy to remember these risks by using the acronym STAR. Sharing the risks. Sharing two or more individuals and businesses agree to pay a portion of any loss incurred by any member of the group. Stockholders in the corporation share the risk. Transfer. Risk transfer is what the insurance and insurance companies agree to pay if the insured customer has a loss and the insured no longer bears that risk. The individual has a cost to form a premium payment, but the contrast to the loss, which the loss is uncertain. The premium is much smaller. Certain avoidance. Risk avoidance means eliminating a particular task, risk, not engaging in certain activity. The example: an individual who does not drive avoids the risk of injury. Somehow, someone in the automobile collisions and be found held liable for those damages. Retention. Risk retention means the individual or business will pay for the loss of its incurred or the portion of the loss via the deductible. If you do not have insurance or pay for the damage you caused to the other person in the accident, you have retained that risk. Reduction. Risk reduction refers to the lessening of the chance that the loss will occur, or lessening the extended of the loss if it occurs. If the business installs a sprinkler system in a building, this will help reduce or eliminate the damage caused by a fire. Insurance uses risk management methods of transfer to spread of risk and loss among thousands, if not millions, of insured. Not everyone will experience an accident while the own of the insurance policy, but the large number of insurers who do not have an accident will pay for the losses of those of the few that do accidents. This is the only way that insurance can work to make the premiums affordable. Methods of handling risk: star sharing, transfer, avoidance, retention, reduction. Star methods of handling risk: star sharing, transfer, avoidance, retention, reduction. Parties to an insurance contract. Here we go. Insurance contracts have two parties. The first party is the insured, and the second party is the insurance company or the insurer. This legal enforcement contract defines the limits of coverage provided to the insured and the risk of loss being transferred, and it identifies under circumstance the insurer will pay for as loss. Parties to the contract: insured to insured. Contract policies and agreement between the insured and the insurer. First party: insured, the customer. Second party: insurer, insurance company. We see quick quiz: an individual applies for an automobile and obtains coverage from ABC Insurance Company. Who is the first party in the contract? The insurer, customer. The insurer, insurance customer. The agent, the insurance agent is A. Each statement best describes a peril. Gas can to an insured's garage are leaking and increasing the likelihood of a fire. A tornado damaged the insurer's home. Commuting to work exposes the insurer to loss. Smoke causes the insured to pay higher premiums for life insurance. A tornado damages the insurer's home. B. The best examples of reduction is a risk management technical. Is the best example of reduction of risk management technique is choosing not to go skydiving, buying an insurance policy, wearing a seatbelt in the car, increasing the deductible, wearing a seatbelt in the car, buying an insurance policy. The best example of reduction of risk reduction. The best example of reduction as a risk management technique is buying an insurance policy. Wearing a seatbelt in the car. Both of them. Yeah, it's probably, I don't know. Tiffany Lee, what are they gonna say? Let's see. Tiffany leaves her car unlocked when she goes shopping. She figures her car is in the contents were insured, so there was no reason to worry. Which type of hazard is this an example of? Careless, moral, morale. Says the flood is an example of. A flood is an example of peril. Other insurance concepts. Alright, they just gave us a quiz there, so I think I'm just going to cut this here and we'll come back and we'll do some more later. That way we don't keep this shit too long. I don't know where the answers are, but the only one that I'm not really sure about that I may need to check on is the best example of reduction of risk management technique is buying an insurance policy, wearing a seatbelt in the car. Anyways, maybe maybe I'll put it in the comments or in the description. This is KING-KAMBUF, 100 proof, bringing you nothing but the truth. I've had my insurance license before. I went and got it on a whim. Went and took the class and studied up real quick, crammed, and passed the test. But I didn't do nothing with it. I let it expire. So we're gonna go back and reclaim it. So I'm putting together this documentary of me reading this, so man, we can just play this stuff into the future and help. But anyways, KAMBUF. Amen.